What is going on, everybody? It's Spencer Gray, and this is the Gray Report. If you are a multifamily investor, maybe you're an aspiring investor, maybe you're already in the business and you are an industry insider. Well, luckily for you, this is the exact place you want to be, because here at the Gray Report, we try to break down everything that's going on in the multifamily industry, real estate, and the economy. And we've had a crazier week so far. Kind of this whole Evergrande scandal, this massive real estate developer out of China has a lot of debt that they can't pay off. They have notes that are coming due, and it has sent shockwaves not only through China, real estate, just the global economy. There was a huge sell-off in the public markets yesterday, seeming to affect everything. But how long-standing is that? What is Evergrande? What does it mean for global real estate, the economy, and what does it mean for U.S. multifamily? You're maybe asking, how can U.S. Chinese developer affect U.S. multifamily? Well, some ways it can, some ways it cannot. We're going to get into it. Again, we're going to bring in Matt Boston, the Director of Communications and Marketing here at Gray Capital. Let's just get into it. All right, welcome again to the Gray Report. But first, before we get into all this crazy Evergrande stuff, if you haven't subscribed to the Gray Capital YouTube channel, if you could just take a moment real quick, subscribe to this channel. We're going to keep you up to date with everything going on. Again, multifamily real estate and the economy. And if you'd like to receive all the latest research reports, articles, opinions, the latest data that comes out related to the real estate industry, specifically multifamily, you're going to want to hop on over to graycapitalllc.com/newsletter. We have an excellent newsletter that we think that you need to be receiving every single week. You get it in your inbox every Thursday morning at 8:30. It's just incredible. We keep getting great feedback saying it is the most valuable piece of email people get in a given week. So hop on to graycapitalllc.com/newsletter to sign up. Matt, what is going on? How's your week? And how has this Evergrande debacle affected your day-to-day life? Because it seems though things in China can affect us no matter what. So how are you doing?
You know what? I think this building's still standing, and I think all of them, there will be no collapse. At least in the U.S. multifamily market. But it is so interesting. And what kind of interests me about Evergrande is this is a real estate developer. They were building apartments in China. But after that, their market is so much different. It is there's so many different forces acting on China. It is not, and everyone says this is not the Lehman Brothers, but it's really hard to draw an analogy between China and U.S. Multifamily market, because the trends of home ownership and all this kind of stuff are so different between the two countries. But yeah, so that's just the upper level stuff. But Evergrande is a Chinese real estate company that's in a precarious situation right now. As far as I know, Evergrande debt is mostly held within China. But the size of the Chinese economy could make this Chinese problem an international problem. That may be the real impact that it might have, is not, is this kind of general uncertainty. And we'll see. I think markets are a little bit more steady now. But I could go on with Evergrande.
Yeah.
So this is
I don't know. I want to know who first made the analogy of this is China's like Lehman moment.
Yeah.
Because that was so systemic, and part of that, but back in 2008, and a lot of that is because the U.S. Economy is, so much of the world economy flows through the United States. The dollar is the U.S. Or the world reserve currency, and so many things throughout the world are denominated in dollars. You don't have the same thing in China, but at the same time, like you said, China is such a driver to global GDP and the global economy. Whether that's inputs, I think they're like using like 50% of like the world's like raw materials and development.
Yeah.
The huge middle class is growing. It's such a growth factor. They're obviously a major exporter. The middle class is growing, so they're transitioning into this consumer-based economy. And then also, it's just been fascinating, obviously, watching the transition. Obviously, we weren't allowed to watch it, but the whole Cultural Revolution, communism, then the opening of China, allowing state capitalism to occur. But then, like you were just alluding to, Matt, in something that I found fascinating. to just get the specifics on, is like the home ownership in China is still so high. I mean, what is it? I mean, it's near like 90% a home ownership
Yeah,
rate in
yeah,
China.
it's easily above 80%. And it was, it was about 90% in around 2017 or so. So so this is not, it's so much different than the US, where US is what, like
Around,
57 or
yeah, just a
something.
little over, yeah, over 50. And again, it's not what you think, because you think of China, you don't think of private property, you don't think of property rights, and I'm sure that they don't have robust property rights, but they do allow you to own to own property or to own your own home, and a lot of people do, and that's what makes this a big deal in China, because I think the real estate in China makes up 30% of their GDP. And unlike in the United States, where most individuals, if they have money and they're trying to put their money somewhere to work for them, they put it in the United States, typically put it in the stock market. You might buy a single family home, but again, only 50% of Americans are homeowners. But most people are putting retirement savings in the stock market. In China, the stock market, you might as well go to the casino. It's not the same type of market that we have here in the U.S. And so most people, they're putting their money into real assets, hard assets. They're putting into real estate, and they're putting it into gold. And so when you have 30% of their GDP in real estate, when you have Chinese real estate taking a hit because Evergrande, second largest developer in China, and as the bonds fail, the bond markets in China, they freeze up, the liquidity dries up, and that immediately affects pricing, because people can't get finance, they can't buy. So if you can't obviously buy, then if you're everyone's just trying to sell, but no one can buy, so the prices continue to drop, and they drop. Again, 30% of Chinese GDP is real estate. That affects a lot of people in China, and a huge part of the Chinese economy. And they're going through this process of building out their middle class. At the same time, President Xi has been doing this transition, to really achieve, more or less, real communism, and they're
Yeah.
using capitalism as
Well,
the means to do that.
and that's, I think, alongside these the shift in real estate, and the differences with real estate and all, and everything like that, is this tension between opening up private markets and having government control over the markets. And it seems like what's really vulnerable is those that connection to the private markets, and that the kind of resilience that it might have because of that. And what they're talking about is trying to discipline these companies and help them pay debts. And this is kind of what led to Evergrande's collapse. And I wonder, I just wonder what that relationship is, and it doesn't seem like a healthy one
Relationship between who?
between the government and Evergrande, and how
Well,
how much
yeah,
they
well,
it seemed like
that's a great point. The question that I had, and we were talking about this, is the Chinese Communist Party is so involved in. I mean, it's a centrally planned economy.
yeah.
Again, they're one of the 500 largest companies in the world. They're the second largest property developer in China. I can't imagine most of what their party leaders, I assume, are all members of the Communist. They are. All the executives are, I'm sure, are all members of the Communist Party. They're getting the okay from the Communist Party. I can't imagine they're able to do so much without the blessing of the Communist Party, if not like the direction of the Communist Party. So if to believe that this is just like a choice of, Evergrande found themselves in this situation, now the Chinese government may step in. This is more, to me, it's like it seems like more of a deliberate action that the Chinese communists are taking on. What are they going to do with all this wealth creation, this expanding middle class, real estate ownership, property rights? And this goes to the same question that this conversation has been having throughout the global economy in terms of real estate. In the United States, I mean, we're talking about bailouts. I mean, now everyone's calling for Evergrande to be bailed out. They're assuming that they will, and that's a relatively centrally planned, more socialist, big government move to, bail out an enterprise. But in China, it's probably not going to be just here you go. Sorry that you messed up. Here's some money. Keep going. It's more of a, we're going to seize your assets. We're going to take complete control, or we're going to let you
Mm,
fail. And if you actually fail, which is much more free market and capitalistic, if they're going to actually
yeah.
let them fail, they're going to, destroy an incredible amount of wealth. But the question is that on purpose or not? Is the purpose to destroy this personal wealth, because wealth is freedom, and it gives people the freedom to do things. And does the Chinese Communist Party want that much freedom, and to see that middle class have that much wealth? But is this the way that they would want to do it? Do they
See, and
want to have
that's
such a
what I was
public?
trying. Yeah, that's what I was trying to kind of describe as what's vulnerable here is not necessarily the government's control. They can take that. But what's really vulnerable is the investments of these people and the ability for their market to really be open to the kinds of capitalist investment that's without risk. That's without that threat of a defaulting company. Because, and this is another thing too, is the government, I'm almost certain they created the environment in which Evergrande has borrowed that money, whether it's through lack of enforcement of regulations, or the less regulated environment that let them build up this. The alarm bells were going off in 2009. There were
Yeah.
articles. There's a New York Times article that was written in 2009 about their business
Yep.
practices. So that's not really the issue. It just seems like there are things that have been happening, I think, on the government level and on the population level that have brought it to a head.
Yeah. Yeah, and this isn't like the first salvo from the Chinese Communist Party either. They've been cracking down on, a lot of, Chinese tech companies. Jack Ma's gotten, beat up a couple times, not physically, but his when his company Ant was going to IPO, they basically stopped that, and they said,
Yeah.
no, you can't be that big.
Yeah.
Too much power for you. And they're cracking down on gambling. They're cracking down on playing video games and computer games, and
Yeah.
because again, it's more about social control, and that's what we have to really be. What is the point here? And I doubt this is what your point, Matt, is that this has been a known issue for going on a decade. There
Yeah.
have been
Yeah.
people who've been doing research, writing reports saying this house of cards that makes no sense. This company is insolvent. Like they don't
Yeah.
know how they're able to string this along for so long. So this is not a surprise to anyone. But the decision had been made. Okay, they're going down. We're going to at least let them trip and fall so we can be in control of
That's
the
what it feels
situation.
like. I mean, what's due imminently is, and I hate to say this because it's more money than I'll ever see, 83.5 million in interest. That's not a lot.
Yeah.
But then there is, another 47.5 million due on September 29th. But the one that's coming on Thursday, which what that may be today if this is published, the one that's imminently due is a mere fraction of
and again, why can't they record low interest rates? And I don't know anything about financing anything in China, so like asterisks on that. But like I assume that this debt was from not 6 months ago. Maybe some of it is, but some of the debt is from maturing from at least a couple of years. And you would think that the interest rates, again, I assume global interest rates are similarly low, that they'd be able to refinance. Someone would be able to recapitalize them. And again, that all can very easily happen if the Chinese Communist Party said, we want you to be able to recapitalize or refinance.
Yeah, and that's kind of related to another question that I had, is what really is the downside of China helping with some of this debt, other than I kind of tried to highlight the fact that it could really make its markets a lot more risky, if you don't know if you're going to be paid or not, or get the favor really, or get the attention of a centralized government that is known to not be good at paying attention to multiple things. But it just seems like that's what a lot of people are thinking about, and maybe even betting about, that they will get some kind of partial bailout, because the markets have not really tanked as much as they did. But
yeah, and so yesterday, I guess context. Yesterday seemed like it was a little bit of a scary day because markets were down.
That's Monday for the viewers.
Yeah, sorry, yesterday, Monday the 20th. But I think it was like the 8th lowest day in the last year, like in terms of the stock market. Now, obviously, we've had a lot of volatility over the last year, but that's not including the craziness of like March and April when we saw the huge declines. We've had 8 days that have seen worse declines. So like
Yeah.
it was bad, and I think everyone was talking about a crash before this, because just things had slowed
Yeah.
down. And so that this, I think, happened and everyone was just ready to say, yeah, okay, it's a, it's a dumpster fire. But then like when people are looking around and they're like, well, why? And I was thinking, I was like, well, I'm thinking about multifamily in the United States.
Yeah.
I'm like, okay, because we're closing on our property in a week from today. And I'm like, okay, real estate's in a liquid investment. I'm like, okay, what would cause like the market to absolutely like fall out? Because obviously you don't be buying something that's price is going to decline by a significant amount, even though we're buying it right. And I'm even in that context, I'm thinking, okay, the cash flow is going to be there. I don't see how these bonds are going to affect U.S. liquidity. I don't see businesses laying off employees because of this.
Yeah.
I'm trying to think, where it could affect. And there are a lot of stocks that were down that were like, why are these stock? How are these stocks related to like these Chinese, development bonds? And I just couldn't find a lot of reasons why things would just crumble,
Yeah.
especially if you take a long-term view. But then I kept thinking about, okay, what are all these, kind of second, tier, these tertiary effects? And honestly, some of them were positive. I mean, we've seen more outflows of Chinese investment in the United States over the past several years.
Yeah.
And because they're investing back in China now, if the Chinese real estate market is perceived as less stable, why wouldn't you want to be in the United States? It's the most stable market in the world, or just, maybe Switzerland or something, but it's just like the most stable market you'd want to be in with growth potential. And that's the thing. You can go to a Switzerland, but there's no growth.
Yeah.
The United States has the growth and stability, and because we just bailed out everybody, like over the pandemic. Like we didn't. And again, I'm thinking about United States is supposed to be capitalist, which is really cronyism. It's cronyism everywhere. It's Chinese cronyism.
Yeah. It's like it's a gamble. You never know who's going to get the attention and who's going to get the support, and that's
yeah. But the result is, okay, so do the Chinese investors not come back to the United States, buying U.S. real estate? Do they start buying? I think right away, and I think you already started seeing this yesterday. Is gold buying, because again, it's real in many Asian countries. It's real assets, and gold is very important in a lot of those cultures. And buying real estate is very important. If you can't buy the real estate, if you're going to sell your real estate, then you're probably going to buy gold. I think I would assume. But then the commodities and material prices, that's where, Matt, I think you and I, we were having a hard time figuring out, okay, they're going to slow down construction. That means material costs go down, but then they shut off production of those materials, costs go up. What are your thoughts? Break it down.
So I think that, and when we were discussing this, there's so many kind of parallels, but also differences. And then there's so many tentacles to this kind of problem. And one of them specifically is commodities. There's a lot of steel that goes into building apartments or building the kind of buildings, whatever real estate buildings that they're building over there by Evergrande.
Yeah.
And on the other hand, that's also the site of the production facilities. So if this impacts the continued operation of the production facilities, if for some reason the lower demand means that a lot of these steel mills or whatever that logistics process is, if that goes offline because Evergrande isn't building houses anymore, that's maybe a problem. But short term, lower demand seems like it would mean lower prices for steel in general. And so there is a study that Cushman and Wakefield put out this is one of these studies that really it puts a stronger long-term context, I think, than this. I think that if anything, Evergrande is just part of continuing trends, and nothing there won't be a huge upheaval in commodities prices, mostly because they're just still volatile. There's still prices up and down, and they're just going to continue probably to go up and down. And like you were discussing earlier, if these plants go offline and the price of steel goes up, why wouldn't they just go back online and make steel at that higher price and make a little more money.
Yeah.
So
Yeah. Well, and yeah, exactly. It's like if the prices are really high right now, if China stops building, which I don't think they're going to stop building,
yeah,
maybe they slow down. There's still buyers out there. I mean, I wouldn't think that the plants would shut down until the price hit to a point where it was unprofitable to continue to produce. Maybe they'll see that coming a little bit and shut down prematurely. But I would assume if there were still buyers, they would continue to produce. What with steel prices being still significantly elevated. But maybe again, if China all acts is in one motion and they stop building, which again, their population is growing at a rate, the middle class is growing. Do they really need? We have a global housing shortage. It's not just housing shortage in the United States, or in Europe or in Australia. It's global housing shortage, and so I can't see. And again, not an expert on Chinese real estate or the Chinese housing market. They're not going to go to zero.
yeah.
So I can't see those inputs.
Well, and that's
stopping.
another context that really looped me into the collapse of Evergrande. Aside from its specific, the specific newsworthy collapse, is this idea that China has for the past 10, 20 years been building so much, whether it's apartments or infrastructure or just so much of this physical investment from the government, and to have Evergrande as this not necessarily publicly or not necessarily a government-owned company, but probably played a significant role in that. And I don't think that things are going to make a complete U-turn and they just allow this they just allow this huge part of their building to go down. So I think they're going to keep building.
Not unless there's a strategic plan behind it, and I don't think we totally understand all the details and the nuances. Nor do I have the the understanding of the kind of the cultural desires and the ideological desires of where they're trying to take their country. But it's fascinating to see it happen. But so I think reading what we're reading today and just having this conversation, I'm not too worried about U.S. multifamily. I think it's a good example when you see the stock market take that big of a hit. Why we like being in illiquid assets sometimes. Now, the stock market in a year from now, if you've got the time horizon, it's just a blip. But it is scary when you see some big declines for things that there's no reason to. And I believe, Matt, and maybe someone can fact check me in the comments if I'm incorrect, but because of the sell-off yesterday, real estate is the biggest gainer, year-to-date gainer in the S&P 500. Beating out financials and energy. Financial and energy were the top, and now it's
that's one of the articles I missed about this.
I think I heard that on Bloomberg. So I don't have the article, but we could figure that out pretty quickly. But this is more of a challenge for the listeners, the viewers, to tell us if we're right or wrong.
Yeah.
So
I do think that it is interesting, that this difference between the Chinese home ownership rate and the new, the kind of new, or the normal of U.S. home ownership rate through the pandemic has been to increase. And in China, their growth rate has actually decreased. Now it's still growing, but the price of homes in China, let me bring up this chart here. The monthly year-over-year price. Now this is as of July that I'm looking at right now. It went from it was increasing at 10.7% at the beginning of the pandemic, and then that growth rate is down to 4.6.
Yeah.
And in America, that growth rate dipped a little bit initially, but it has come right back up, as anyone really can tell. So there seems to be larger trends that are happening that Evergrande is just a part of. One of them, as we talked about, is this tension between the private and the private sphere and the government, and the other, I think, is this different relations. Chinese population is still growing, and it's still huge, and there's still an enormous need for housing, but the price is so much different. So this kind of connects with the CBRE report when we're talking about these larger trends in home ownership. So the U.S. home ownership rate is is 57%, or around the 50s, and Chinese has a high home ownership rate. But it also has this interesting relationship between housing price growth and household income growth, and you can see this in a recent CBRE report. And it lists these countries and areas like Hong Kong, China, Japan, Korea, Australia, New Zealand, and then gives United Kingdom and United States as other examples. In all of the places studied, only China and Singapore had household income growth greater than housing price growth. You look at that chart,
and I guess just a couple of comments. One, can we even take like the information we're getting out of China very seriously? Because we don't really know. Their numbers are often kind of whitewashed and in like very round numbers often. Yeah. And now I'm sure they can't fudge it that much, and we have to go off what we have to go off of. But I'm just so that's one point. And the second part of that is I'm just the housing prices. I'm wondering just what are the controls on those prices, and is there somebody that actually is like has their hand on the throttle of home prices, and is there a little bit more regulation on home prices? I don't know the answer to that, but I'm just throwing that out there to see if that is.
Yeah, I mean, and if you look at it, China's housing prices growth was it was a little under 100%, and then their income growth was about 135, 138%. It's a huge gap, and whether it's reported accurately or not, it is an interesting counter trend to what we're seeing in the United States.
So and I wonder, and the other thing that China has going on though, that different from all of these other examples, is just China is still a developing country versus United States, UK, Singapore, New Zealand, Australia, Korea, and Japan, even Hong Kong. I'll say Hong Kong, even Hong Kong, where we've had a middle class in the United States for quite some time. China basically had no middle class, and their middle class is growing, and so in their income, household income is growing, but it's if you look at where it was growing from, next to nothing to now reasonable amount, still maybe low compared to the United States. It's still interesting. It's just there's just a lot of factors when we're trying to kind of break into what's going on.
It seems like I may be out of my depth when it comes to the nuances of Chinese real estate, but it does definitely seem like there is a significant population growth and economic growth in China that is trying to be managed by a central government, and it is and that is getting messy. So that's an easy generalized statement.
And I think that I think that is. I think it's a good point. Is you can have the best plans in the world, but your plans don't always work out the way you wanted to. And if you're totally centrally planning everything, everyone's doing the same thing. If that plan doesn't work out, you can solve bigger problems, but you can also create incredibly large problems that are unfixable because you only have one central control to fix it. And if that doesn't work, you're up a creek without a paddle, versus having a more decentralized system. There's a lot more actors, a lot more problem solving that goes on. Maybe you can't take as big of action as quick because you can't just by fiat or by dictate do this. It requires consensus. It makes it less efficient. It's a feature. So Matt,
that's kind of what's interesting to me about this in terms of like its parallels is, everyone's saying, is this going to lead to collapse? But everything that we're hearing, all the details about the moving parts about this collapse, it bears so little relationship with the kind of the real estate market in the US. So it's in a way, it's a little bit comforting, but there is still that threat of the kind of interconnectivity of the financial world.
What I was worried about, I was not too worried yesterday. I mean, I was watching it, I had, Bloomberg, on, up, throughout the day yesterday, and just kind of monitoring things. Because when I saw the S&P 500 cross the 50-day moving average, I'm like, okay. because it doesn't matter what's going on fundamentally, but if technically if you cross certain thresholds or certain patterns emerge, then
Yeah.
you've got all the the human technical traders who are responding to that. Then you have all the algorithms,
Mm.
and the high frequency trading that's responding to those technical factors. That okay, it's cross 50-day, okay, sell, 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 sell. And the next line is that 200-day moving average, which would be pretty significant decline. I think again it would be like a 10-12% decline in the S&P 500, which a lot of people have been calling on as a healthy thing. So what got me to concern is like, there's no like relation between these bondholders and in the fundamentals, but but it's more the trading off of technicals and the perception of fear driving
Yeah.
things more than really reality. And perception is reality, in
Yeah.
most cases. So all cases, I guess. And so that was when I saw that, I was like, can we not just have like what do we have to have like a technical sell off just to do it? And then full circle though, okay, so Federal Reserve isn't tapering is what I read all this. Like
Yeah.
let's just
Yeah.
like break it all back down. What really matters, even though it shouldn't matter, is the Federal Reserve is not like they're not going to accelerate tapering because of this. They're not going to raise interest rates when this is going on. And are they even going to start tapering before the end of the year now?
Yeah.
Like
There's
let's start
that.
taking up
That's
let's start
another,
cool.
yeah, that's another point, is that the market seems to be pretty reactive in general right now. And so I don't think the Fed is going to really see a roaring, robust
No.
recovery.
The market has been like daring the Fed to like be somewhat hawkish. I mean, they're basically been like, oh, things are ready for a crash, ready. Things are
Yeah.
slowing down between Delta, between everything else, between growth slowing down. I mean, we've talked about, I think, and we went into it pretty well last week looking at that CPI report, and we've got decelerating growth, which is
Mm-hmm.
healthy. We don't want to see crazy growth. And so things are slowing down and people are just
Yeah.
kind of like pumping the brakes, and things are coming into, division. And people are saying, okay, well, if you start tapering too quickly, too large, in a too big of a way, raise interest rates, we're going to bring the whole economy crashing down. And nobody wants
Yeah.
that. And that'll go against your mandate of full employment and stable prices. So
Yeah. Yeah. That's something that will be true, whether once the Evergrande comes and goes, is that's what people, yeah, a lot more relevant to the
and at the end of the day, it's
industry.
because there's this global search for yield, trying to get any yield out of anything. And because people are even watching the corporate bonds yesterday, and they really weren't moving, because if they go up in yield, if they go down in price, people are just snatching them up, so they're looking for yield. Same thing
Yeah.
with real estate, same thing with any kind of incoming produce any income focused asset. There's just there's not enough of it out there. And so people are
Yeah.
buying it up and they're backstopping, not to mention that the work that the central banks are doing around the world.
Yeah.
So kind of just, this is so meta and so macro. But at the end of the day, it's like, is this even actually good? This is maybe even a positive force for multifamily in the United States, as crazy as that can sound. And as backwards as it might be, crash somewhere is actually positive for real estate in the United States, because lower interest rates, more buyers from China, maybe even like softening commodities prices and input costs. That would be kind of
Yeah.
nice. We're getting some good growth, but again, interest rates are going to be low. I'll take it, I guess. We're gonna close in the deal next week. I'll tell you that much. Okay, Matt. So just real quick before we close out this awesome episode of the Gray Report, just got a quick question. 2 resources you find indispensable to stay up to date that help you put together the Gray Report, because you're the guy that's kind of behind the scenes putting this awesome Gray Report newsletter together. 2 indispensable resources. I don't want to give away like the secret sauce. I don't think anybody can figure that out, because the secret ingredient is love that you put into the report. So, but two resources indispensable, stay up to date. What do you think? What are they?
Yeah. So I think one of them, for kind of mainstream news about the commercial real estate markets, and including a lot of multifamily news, I think Globe Street is probably the best straight continual news site for for commercial real estate and multifamily. I think when you're talking about reports and the researchers at RealPage continually put out lots of, they're not necessarily fully in depth, although they do some, but they have regular updates and regular raw numbers on a lot of the trends that are happening in the multifamily market.
Two great resources, Matt. I would have to agree. There's a lot of good ones out there that we feature, you feature. Yeah, RealPage and Globe Street, two definitely very consistent participants that you'll find on the Gray Report, either the website or the newsletter. Good stuff. I would say, if I had to pick two, and it's tough, and I might go a little bit different. Well, so one, I would say, and this isn't multifamily, but if you're not regularly, once a month going to the Fred website, the St. Louis Fed's website, Google Fred, St. Louis Fred, they basically keep track of all the statistics, tracking the economy, macroeconomics. It's up to date, figuring out where break-even inflation is, where home ownership rates are, inflation, all kinds of really interesting stuff. A lot of useful tools. You can kind of compare a lot of data. I find that really interesting. Not multifamily specific. And this is something everybody knows. It's Bigger Pockets. Just as an educational resource, not necessarily like intelligence, but you'd be surprised. There's a good amount of information you can find on Bigger Pockets. Most of our viewers are overly familiar with Bigger Pockets, probably most of those resources we mentioned, but good stuff. Okay, Matt, pleasure to have you on Gray Report again. Good stuff. I know this is a little bit different. We're getting really into specifically this Evergrande. It was a big story yesterday. On Monday, I'm going out of town. I'm going to be in meetings all the rest of the week, so we couldn't do the recording when we typically do it. So let's just get into this whole Evergrande thing and break it down. Well, folks out there,
so there's still a lot to learn. So
you're gonna have to read the entire newsletter.
That's right.
To get all the reports.
There's still news that's going to happen. So It's worth paying attention to our newsletter.
It is. And again, like I said earlier, I got another awesome review, and we need to accumulate and put together all these testimonials. But again, Matt, this is to your credit. This is much less time, but it's really on you. But just so much enthusiasm for the value of the newsletter, and because it's putting all this useful information just in one spot, and it's just really consolidating it. And I think that we maybe been on something. This whole newsletter, when we decided to do the newsletter, was kind of like, who does newsletters? But it's we appreciated them. Or some newsletters we thought were useful. What I saw was interesting. It was in my Google News, and it was asking me to sign up for a Google News newsletter. I'm sure customized feed and all of that, but I'm like, okay, I'm like, Google News. I think pretty sure Google News gets most web news traffic. Most people are getting the news from Google News, then CNN, Fox News, whatever. The Google News people, Google. You think email, they're now doing a newsletter. You'd think that Google News would be the premium way to get everybody all their information, but they realize there's a demand for people to get this information straight to their inbox. And you can put together a feed on Google News or, an RSS feed. It's not going to come close to the Gray Report newsletter. Because we have all those. We have all those, but you still have to curate it.
Yeah, a lot of news comes by a lot. And that's one thing I try to do is just try to find the good ones. The best in the week.
Don't give away the secret sauce, Matt.
I can't. Well, a little bit of love. That's and we got a whole lot at Gray Capital. So
okay, all right. Great episode of the Gray Report newsletter. Again, subscribe to the channel. Give us a like. Hop on over to graycapitalllc.com and grayreport.com. All good stuff related to the multifamily industry, real estate, and the economy. We'll see you next week. Bye.